The interest rate difference between China and the United States affects the demand and supply of yuan and dollar in the global market. In general, a higher interest rate in one country attracts more foreign capital inflows, which increases the demand for its currency and causes it to appreciate. Conversely, a lower interest rate in one country discourages foreign capital inflows, which reduces the demand for its currency and causes it to depreciate. In recent years, China and the United States have had different economic cycles and monetary policies, which have widened or narrowed the interest rate gap between them. For example, in 2018, the U.S. Federal Reserve raised its benchmark interest rate 4 times to 2.5%, while China's central bank kept its policy rate unchanged at 4.35%. This widened the interest rate gap between China and the U.S. to 1.85%, which made the U.S. dollar more attractive to investors than the yuan. As a result, the yuan depreciated by about 5% against the dollar. However, in 2021, the situation reversed. The COVID-19 pandemic hit the U.S. economy harder than China's economy, which recovered faster from the outbreak. The U.S. Federal Reserve cut its benchmark interest rate to near zero and launched massive quantitative easing to stimulate the economy, while China's central bank maintained a prudent monetary policy stance and reduced its policy rate by only 0.3%. This narrowed the interest rate gap between China and the U.S. to 0.95%, which made the yuan more attractive to investors than the dollar. As a result, the yuan appreciated by about 7% against the dollar in 2022. However, the trend changed again. The U.S. economy rebounded strongly from the pandemic, while China's economy faced downward pressure from trade friction, financial risk prevention, and structural reforms. The U.S. Federal Reserve started to raise its benchmark interest rate again to curb inflation, while China's central bank eased its monetary policy further to support economic stability. This widened the interest rate gap between China and the U.S. again to 1.55%, which made the dollar more attractive to investors than the yuan. As a result, the yuan depreciated by about 14% against the dollar. The interest rate difference between China and the U.S. not only affects the exchange rate of yuan and dollar, but also affects the cross-border capital flows and asset prices in both countries. When the interest rate gap is wide, more capital tends to flow from the low interest rate country to the high interest rate country, seeking higher returns. This can boost the asset prices in the high interest rate country, such as stocks and bonds, while depressing the asset prices in the low interest rate country. For example, in 2018, when the U.S. interest rate was higher than China's interest rate, foreign investors increased their holdings of U.S. assets by $1 trillion, while reducing their holdings of Chinese assets by $67 billion. This contributed to the strong performance of U.S. stock and bond markets in 2018, while China's stock and bond markets suffered losses. However, in 2021, when China's interest rate was higher than U.S.'s interest rate, foreign investors increased their holdings of Chinese assets by $1 trillion, while reducing their holdings of U.S. assets by $120 billion. This contributed to the strong performance of China's stock and bond markets in 2021, while U.S.'s stock and bond markets experienced volatility. In 2022, however, when the U.S. interest rate was higher than China's interest rate again, foreign investors reversed their positions again. They increased their holdings of U.S. assets by $800 billion, while reducing their holdings of Chinese assets by $200 billion. This contributed to the recovery of U.S.'s stock and bond markets in 2022, while China's stock and bond markets faced pressure. In summary, the interest rate difference between China and the United States affects the demand and supply of yuan and dollar in the global market, which influences their exchange rate movements. It also affects the cross-border capital flows and asset prices in both countries, which reflects their relative attractiveness as investment destinations.